Good day, everyone. In today's class, we are going to be discussing the concept of capitalized pricing model, a practical and very interesting topic in strategic financial management or corporate finance. The capitalized pricing model is a continuation of portfolio theory, and in today's class, we are going to be dissecting the introduction to capitalized pricing model, the areas of application of capital asset pricing model, the underlying assumption of capital asset pricing model. Not only that, we are going to discuss beta value and how to compute beta value. Then we are going to discuss alpha value and how to compute alpha value. All right. Then thereafter, um, we are going to have practical examples. Okay. So let's take it one after the other. All right. So what do you understand by capital asset pricing model? The capital asset pricing model is a model that is designed to establish the relationship between expected return and the systematic risk of assets, especially stocks. Uh, the CAPM asserts that the expected return of assets vary only by their systematic risk. Since the unsystematic risk can be eliminated through diversification. So the focus of capping is on the expected return and also on the systematic risk, because it's not talking about total risk, but basically on the systematic risk, because the unsystematic risk can be avoidable, can be eliminated through diversification. All right. Not only that, the general idea behind capital asset pricing model is that investors need to be compensated in two different ways, including one for time value of money, which is uh, is the rate of return associated with the uh, government securities like treasury bill, government bond, risk-free rate of return. All right. Then the second part, number two, areas of compensating the investor is for taking additional risk. In addition, the capitalized pricing model stipulates that expected return of a security will equal the risk-free rate of return plus a risk premium. If this expected return, okay, does not meet or exceed the required return, then the investments will not be considered or should not be undertaken. So the expectation of the investor is that um, the expected return will meet the required return or even surpass the required return. But if the investment fails to meet the required return, then that means it is not viable. It should not be considered. It will be too risky for the investor to put in money. All right. So these are the general ideas and then the concepts of capital asset pricing model. What are the areas of application of capital asset pricing model? There are basically three key areas in which capital asset pricing model can be applied. One is to price risky assets. One is to price risky assets. Stocks are considered to be the most risky assets. So when you want to determine the price of stocks or share price, then we use capital asset pricing model to do that. Then number two, capital asset pricing model can be used to generate expected return on assets. Okay, when you want to determine the expected return on assets, then of course you use capital asset pricing model. Then three, capital asset pricing model can be used to determine or to calculate the cost of capital. All right. So these are the three common uses of capitalized pricing model. Then let's talk about the underlying assumptions of capitalized pricing model. There are about 7 assumptions of capitalized pricing model. First one is that investors are risk averse, utility maximizing, and rational individuals. A risk averse investor is the one that do not like risk. Despite the fact that a rational investor do not like risk, they still want to maximize their utility, their satisfaction. All right. A rational individual or a rational investor is the one that is conversant with market operations. Okay, he is aware. Rational investor is aware about the relationship between risk return trade-off. Okay, is aware about the risk return trade-off associated with the investments in the portfolio. Then number two assumption of capitalized pricing model is the fact that markets are frictionless, including no transaction costs and no taxes. In fact, in practice, this is not possible. There is no way you invest and then as an investor that you are not going to incur transaction costs. All right. Then again, the assumption states that there will be no taxes. If as an investor you earn cash profits, it's expected that you are going to pay tax. Okay, you are going to pay tax on that. Even if you are not investing as a company, provided that, of course, withholding tax may apply on that investment. So there is no how that you're not going to pay tax. All right. But in theory, we are saying that okay, there will be no taxes and also there will be no transaction cost. Number three assumption is that investors plan for the same single holding period. All right. Then number four, investors have homogeneous expectation. Again, in practice, this is not realistic. There is no way all investors will have the same expectation about the investment. We are different individual with different experience, with different exposure, with different expectation. Again, it's just theoretical. So the fact that investors have homogeneous expectation is theoretical. It's not realistic. The next one, the next assumption is that investors are price taker. To some extent, yes, that may be right because the market participants, the interaction of demand and supply or the market forces of demand and supply will determine the prices to be traded with. So generally, no single individual investor will be able to determine what price to trade with. So it is the market's forces of demand and supply that will dictate. So let me add one more. Yeah, all investments are infinitely divisible. Again, this may not be possible in practice, saying that all investments, say you have investment A, investment B, whatever the number of investments you have in the portfolio, all of them are divisible, meaning that fractional parts of those investments can be undertaken. You can take 70%, you can invest 70% on a particular security, you can do 30% of another one. So what it's saying is that it's not compulsory that you have to do 100%. So they are infinitely divisible. All right. Again, almost all the assumptions uh, of capitalized pricing model are not realistic in practice. They are purely theoretical. All right. So that is that. Let's talk about how to estimate capital asset pricing model. Let's talk about how to estimate capital asset pricing model. Of course, we have done a lot of calculation under capitalized pricing model. So when you want to calculate capitalized pricing model, so CAPM, let me write that, calculating capital asset pricing model. CAPM denoted as RX, that's the expected return. So CAPM is computed as the risk-free rate of return plus the beta value multiplied by market return minus the risk-free rate of return. So the risk-free rate of return is the rate of return associated with government security, like treasury bills, all right, government bonds. All of these are risk-free. When you invest in those securities, then of course your investment is secured. This is because government is not going anywhere and the government is continuing. So we continue to, your money cannot be, your investments cannot be eroded. So it's secured. So the difference between the market return and the risk-free rate of return is what is called risk premium. Okay, this is the difference between between those two is called risk premium. That's what an investor is expecting. In addition to the the time value of money. So in addition to the risk-free rate of return, they also expect a risk premium on their investment to compensate them for taking additional risk. All right. So this is how to calculate capitalized pricing model. So let's talk about concept of beta. Let's talk about concept of a beta value. Like we discussed under portfolio theory, beta is a measurement of risk. We use beta to measure risk. And then the higher the beta, the higher the risk of the portfolio. Basically, there are three types of beta. One is positive beta, two is negative beta, then three, zero beta. The positive beta indicates that the return of the assets follow the same direction of that of the market. I repeat, positive beta indicate that the return of the assets follow the same direction as that of the market. Negative beta shows that the return of an asset is in the opposite direction of that of the market. I repeat, negative beta shows that the return of an asset follows the opposite direction of that of the market. The third one, which is zero beta. Zero beta indicates that there is no relationship between the market return and that of the market, between the return of the security, rather, between the return of the security and that of the market. There is no correlation. So those are the three types of beta. Then, one thing you should know is that the risk of the market, let me put it down, note, let me write this, note, the risk of the market. When you say risk, what we are trying to say is beta. The risk, that is beta, of the market is always 1. Okay, it's always 1. Which means that if the beta of the security is greater than 1, it means that the risk of this portfolio is higher than that of the market. That means the risk of the portfolio, this portfolio is riskier or is more risky than the market. But if the beta of the portfolio is less than 1, it means that the risk of the portfolio is lower than that of the market. Okay, so at all time, whenever you compute beta value, you're expected to juxtapose to relate with the market risk. Okay, so but just note that the market risk is always 1. All right, so how do you then estimate beta? How do you estimate beta? To calculate beta value, there are 5 different formulas that can be used to calculate beta value depending on the information available. So I'm going to give you the entire 5 formulas and then you have to memorize all of them. So let's take it one by one. Calculating beta. Calculating beta value. Like I said, there are 5 different ways you can compute beta value depending on the information available. The entire 5 formulas, I will provide it in order of frequency. So number 1, if correlation coefficient, let me write that please. Okay, if correlation coefficient is given, so if correlation coefficient is given, if correlation coefficient is given, then beta value will be computed as correlation coefficient multiplied by the standard deviation of the security over standard deviation of the market. Okay, then number 2, if covariance and variance are given. Okay, that's another one I'm supposed to include then. So if covariance and variance are given, then beta value will be estimated as covariance of the security divided by the variance of the market. All right, so that's that. Then this one, let me include standard deviation. So if correlation coefficient and standard deviation are given, okay, so you're expected to use, let me write everything, correlation coefficients and standard deviation are given. Okay, that's that. Then number 3, if information or where information on number of shares, market price and beta of individual securities are given, then in that case you're expected to use weighted average method. Are given, weighted average method should be used to compute the beta value as shown below. So when you want to calculate the overall beta of a portfolio using weighted average method, if in the question you are given number of shares and the share price, including the beta value of individual securities, first thing first, you are going to calculate the total market value and the total weight of the entire portfolio. To do this, you are going to create about 5 columns. One, the first column will be for the companies in the portfolio. Then 2, the number of shares. 3, the market price per share. Then 4, total market value. Then column 5 will then be the beta value of individual security. Then column 6 will be for the weight. So let's say this is A, this is B. C will be equal to A times B. Then this is D. E equal to C multiplied by D. Okay. Say you have 3 companies, investment in 3 different companies. Say company A, B, and C. Okay. All right. Here is total. So you have this, you have this, you have that. So to get the total market value, just multiply the number of shares with the market price per share. The beta value of individual security will surely be given. Then to get the weights, just multiply the total market value with the beta value of individual to get the overall total weight, then total market value. So to now get the overall beta, the beta of the portfolio will then be computed as total weight divided by total market value. So if in the question you are given the number of shares, the market price per share, and then the beta value of individual securities, this is how you are expected to calculate the overall beta. The fourth method that you can use, formula that you can use to compute the overall beta or to calculate your beta value, is if you are given regression analysis information. So if regression analysis is given, analysis information is given, then in that case, beta value will be computed as n summation xy minus summation x summation multiplied by summation y divided by n summation x squared minus summation x all squared. So this is the formula for calculating the beta of the portfolio or the beta of the security if you are given regression analysis information. X is the return on the market, y is the return on security, n is the number of period. It could be January to December, it could be year 1 to year 6, whatever the period given to you. All right. So that's that. And finally, the fifth formula that can be used to compute beta value is where you are given excess return on security and excess return on the market. Where excess return on security and of the markets are given, then in that case, beta value will be computed as the excess return on security, which is the expected return minus the risk-free rate of return, divided by excess return on the market, which is return of the market minus the risk-free rate of return. So these are all the 5 formulas that can be used to compute beta value, where the available, whatever the available information you have, because information you are given in the question, will tell you the direction or the formula to use. Okay. One can ask, is it possible for examiner to ask us to use a specific formula? No, it is implied in the question. So whatever the information, whatever the scenario that is being painted by the examiner will determine the kind of formula that you are going to use. However, it's important for you when you are writing a provisional exam, it's important for you to memorize, okay, master all the formulas, because you don't know where examiner will come out to you. So the next item we want to discuss is estimating beta value, alpha value. So what is alpha? What is alpha? How do you estimate alpha? Okay, what is alpha and how do you estimate alpha? So alpha represents the difference between expected return and required return of an asset, okay, or the difference between expected return and the required return of assets in a portfolio, and it is computed by carrying out by using the following formats. Okay, you can use the following format to compute alpha value. So let's quickly do that. Remember I said calculating alpha denoted as this, and I said alpha is calculated as expected return minus the required return of an asset. Generally, the expected return will be given to you, but the required return will never be given. Okay, in most cases, the expected return will be given, but the required return will not be given. The required return is the CAPM. Okay, all right then. So how do you then compute the alpha? So to calculate the alpha, all you need to do is to create about 4 columns, one for companies in the portfolio, one for expected return, one for required return. So, and then one column for the alpha. If you like, you can include column for comments, because it is expected that once you compute your alpha value, you are expected to interpret your result. So let's say this is A, this is B, this is C, equal to A minus B. All right. So say for example, you have company A, company B, then company C in the portfolio. All right. So the expected return, like I said, will be given, but the required return, you need to go ahead and compute the capitalizer pricing model. You calculate CAPM, whatever you have, come and put it there. All right. So the difference between the expected return and the required return will give you the alpha value. So your alpha value, the security could be undervalued or overvalued or rightly priced or rightly valued, whatever it is, just put it there. However, when you compute your alpha value, it's expected that you are going to interpret your results. If you are writing a professional exam, whether you are asked by the examiner or not, you are expected to make a recommendation or advice or on what needs to be done on the investment. So generally, when you want to advise, okay, let me push this one down. Generally, when you want to advise, there are three ways depending on the alpha value computed. So interpretation, okay. Number A, if expected return is greater than the required return, okay, it means the securities is undervalued. So if the security is undervalued, what are you supposed to do? Of course, because it is underpriced, then you need to buy more of the security. Therefore, more of the security, more of the securities should be purchased. Okay. Then number B, if expected return is less than the required return, it implies that the securities are overvalued. So if the securities are overvalued, what are you supposed to do? You dispose it off. Hence, the securities should be sold. Then number C, if expected return is equal to the required return, okay, it means the securities are properly priced, are properly or appropriately priced. So if the securities are properly valued, what are you supposed to do? You keep it. All right, you keep it. Therefore, the securities should be kept. The company should hold on to the security. So that's this. So these are the ways you are expected to compute. This is how you are expected to compute the alpha value and interpret your result. Again, whether your examiner asks you or not, it's important for you to advise. You need to provide a professional advice on what needs to be done on the securities in the portfolio or on the short-term investment. Okay, I think we are done with all the explanation of the concepts under capital asset pricing model. The next thing we want to do now is to have practical illustrations. So let's have practical illustrations. Okay. All right. Let me see. So let's start with these simple illustrations. Let's start with this simple illustration. Yes. Let me change the color of my pen. Change it to blue. Okay. So Adobe PLC has a project with a lifespan of 1 year. That's the useful life. While Adobe PLC has 3 projects in different industries, each lasting 1 year. Okay, the same useful life. The net cash inflows and beta factors associated with the project are as follows. We are given information on the companies, the projects, cash flows, and beta factor of individual projects in the portfolio. The market return is 10%. Okay, this is market return. And the risk-free rate of return is 5%. Okay. Required, calculate the total present value of project undertaken by 1. Ado, 2. Bado. C. Determine the overall beta of Bado PLC, assuming that all the projects are undertaken. Then C. Explain how portfolio diversification reduces the risk experienced by any investor. So to solve this question, you are asked to compute the total present value. How do you compute total present value? Present value is the same thing as market value. So when you want to compute present value, all you need to do is to discount the future cash flow and you sum the number. You discount the future cash flow to the present value equivalent. That's all. Okay? So number A, solution. Number A, requirements. Calculating total present value. Okay, total present value. So how do you compute present value? Simply multiply. So present value is computed as cash flow multiplied by discount factor. Okay, if in the question the project has more than 1 year life, it means that you need to calculate, and then if your cash flow is constant, like in this case, is constant all throughout the period, then you need to calculate annuity factor. But as far as this question is concerned, the useful life of the project is 1 year, the cash flow is constant. Okay, for example, for Ado, cash flow is 100 million. Therefore, all I need to do is to multiply the 100 million with the discount factor of year 1. All right, so multiply by discount factor. Therefore, for Ado, will then be equal to cash flow of Ado is 100 million naira multiplied by, let me remove the million, multiplied by discount factor. Examiner did not, we are not given cost of capital in this question. So there is no way you'll be able to determine your discount factor. So I need to look deeper in the question. How else can I compute my cost of capital? In this question, I'll be given information on CAPMs because I can see risk-free rate of return of 10%. I can see, market return of 10%. I can also see risk-free rate of return of 5%. So this is information of CAPM. In that case, I need to go and calculate expected return. That my expected return will serve as a cost of capital because it is simply implied that both Ado and Bado are only financed with equity. There is no debt in the capital structure of both companies. Therefore, let us go and calculate expected return. Okay, expected return. Let me use this space as my working. Working. I want to calculate expected return. Calculating CAPM. So CAPM is calculated as the risk-free rate of return plus beta value into market return minus risk-free rate of return. So according to the question, according to the question, the risk-free rate of return is 5%. This is 5% plus the beta of Ado. Let me write this. Let's separate. This is for Ado. So A is 5 plus the beta of Ado according to the question is 1.2. 1.2 is the beta of Ado. So multiply by 1.2 into market return of 10 minus risk-free rate of return of 5. This will give 5 multiplied by 1.2 equal then plus 5 equal 11%. So the cost of capital of Ado is 11%. So let's compute for Bado. For Bado PLC, there are 3 different projects. Okay, project 1. For project 1, so the risk-free rate of return is still the same thing as 5 plus the beta value of project 1 for Bado is 1.5. Here is 1.5. The difference between market return and the risk-free rate of return is 5. Okay, so equal to 5 multiplied by 1.5 plus 5 equal to 12.5%. Okay, project 2 is the same thing. 5 plus 1.5 into risk premium of 5, 12.5%. Project 3 equal to 5 risk-free rate of return plus 0.9 into 5. This will be equal to 9.5%. Okay, so if that is the case, I can then proceed to calculate my present value. So the cost of equity of Ado is 11%. Therefore, my discount factor will then be, since it is 11%, my discount factor is 1 plus R raised to power minus N. Therefore, 1.11, 11% is the cost of capital of Ado. That will be 1 plus 11%. That will be 1.11. 1.1, the useful life, which is N, is 1. So minus 1. So this should give me, bring out the calculator, 1.11 raised to power 1 minus equal, then multiply by 100 equal, that's 90.1. Okay, the total present value of Ado PLC is 90.10 million. That's that. So let's compute for Bado. PV of Bado. PV of Bado. Because Bado has about 3 projects, so let's use a table to do that, so that we have a good presentation. So we have column for projects, cash flow, then we have discount factor. Okay, discount factor, then we're going to have the present value. Okay, so we have project 1. Of course, cash flows are in million naira. So we have project 1, project 2, project 3. The cash flow given for the projects for Bado is 25, 25, and then 50. 25, 25, then 50. Okay. Then the cost of capital for Bado is 12.5%, then 9.5%. So we computed cost of capital for the project of Bado, 12.5. So this will be 12.5% is the same thing as 0.125. So 1.0125 raised to power minus 1, 1.0125. Let me confirm that. You have to be very careful. So 12.5 divided by 100 equal, so plus 1. So there's no 0 there. Okay, it's supposed to be 1.125 minus 1, 125 raised to power minus 1. So then here will be 1.095 because it's 9.5, so minus 1. So let's bring out the calculator. Raised to power 1 minus equal, then multiply by 25 equal 22.22, 22.22, 22.22. Then 1.095 raised to power 1 minus equal, multiply by 50 equal 45.66, 45.66. So we add up everything. So this will produce total present value will then be equal to 90. All right, this is 90.10 million. So that's the total present value of Bado PLC. So we just answered requirement number A. So let's go to requirement number B, whereby you are asked to determine the overall beta factor of Bado PLC, assuming that all the projects are undertaken. So for Bado, we want to compute overall beta value. How am I going to compute the overall beta? Which formula am I going to use to compute my beta value? I've provided you with 5 different formulas. Which of them will be applicable to this? In this question, I've already calculated market value. So I'm also given the beta value of individual securities. Okay. So what else do I need to find? The question is already solved. So all I need to do is to use the weighted average method to compute my overall beta. So number B, requirements, calculating overall beta for Bado PLC. So to do this, of course, I will create a column for the projects. We already have the total market value. We already have the total market value. All right. Then we are going to create a column for the beta value. Then another column for the weights. Okay. So let's say this is A, this is B, this is C, A multiplied by B. So we have project 1, 2, 3. Total market value. The total market value of project 1 is 22.2. This is it here. 22.22, 22.22, 45.66. So that gave us 90.10. That's the total. Then the beta value of project 1 is 1.5. Let me confirm. Yeah, 1.5, 1.5, then 0.9. Here is 1.5, 1.5, then 0.9. So I need to get the total weights. Okay, so 22.22 multiplied by 1.5 equal 33, 33.33, 33.33. Then 45.66 multiplied by 0.9 equal 41.09, 41.09. So let's add it up. Plus 33.33 plus 33.33 equal 107.75. Here is 107.75. That's the total weight. Therefore, overall beta will then be equal to the total weight divided by total market value, which is equal to 107.75 divided by 90.10. So overall beta will then be equal to divided by 90.1 equal, that's 1.20. All right, 1.20. That's the overall beta. So I can then interpret this to say that the beta, the overall beta, okay, the overall beta of Bado projects is higher than that of the market, which is 1. Okay, so that means the risk associated with the projects is higher than that of the market. Okay, so that is that. Then number C, requirement of the question, you have to explain how portfolio diversification reduces risk experienced by any investor. Portfolio diversification is a strategy usually adopted by a rational investor in order to avoid a disastrous or catastrophic financial outcome by investing in securities that are negatively correlated. When you invest in securities that are negatively correlated, it will enable the investments to be resilient to gyration. Therefore, to reduce portfolio risk through diversification, investors should invest in securities that are negatively correlated or investment with no correlations. In addition, to minimize portfolio risk, a rational investor can aim at geographical or international diversification. All right. So these are the ways in which the Bado PLC or a rational investor can minimize the risk of a portfolio. All right, so let's go to the next illustration. Let's have one more illustration. Let's treat this illustration 2. Okay. All right. Balloon PLC has been enjoying a substantial net cash inflows. The funds have been invested in a small portfolio of short-term equity investments until they are needed to meet tax, dividend payments, and to finance further capital expenditure in several months' time. Details of the portfolio, which consists of shares in 4 Nigerian listed companies, are as follows. So we are given information on the companies invested, the holding period, the number of shares held in each of the company, then the market price per share. Again, we are given information on the beta value, okay, information on the beta value, the dividend yield per annum in percentage, then capital gain yield per annum in percentage. The yield on treasury bills is 11%. So yield on treasury bill, the return on treasury bill, this means this is the risk-free rate of return. Treasury bill is government security, so that's the risk-free rate of return, and the market return is 19%. Market return is 19% a year. So required, A, based on the data given, calculate the risk, that is beta, of balloon short-term investment portfolio relative to the market. Then B, recommend, given your reasons, whether the composition of the company's short-term investment portfolio should be changed. Relevant calculation must be shown. C, discuss the factors that a financial manager should consider when investing in marketable securities. All right. So this is the question. Now, what are you supposed to do in this question? In number A part, you are told that based on the information, based on the data given, calculate the risk of the portfolio. So I want to calculate the risk. How am I going to calculate the risk? Out of the five different formulas, how do I calculate my beta value? In this question, I have number of shares. Okay, I'm also given the market price per share. I'm given information on the beta value of individual securities. It means that I'm supposed to use the weighted average method to compute my overall beta. So without wasting time, I will say solution. The name of the company, solution, the name of the company is Balloon PLC. Number A, calculating, I want to calculate overall beta. Okay, the overall beta, since I'm given number of shares, the market price per share, and the risk of individual security, then I will use weighted average. Therefore, I will create a column for the company's number of shares. Okay, number of shares, the market price per share, total market value, then the beta of individual, then the weights. Okay, this is A, this is B, this is C equal to A times B, this is D, this is E equal to C times D. Okay. So, according to the question, the name of the companies invested include Dashing PLC, Elegant PLC, Fantastic PLC, and Gaudy PLC. So let's represent them in letter. That will save time. So here is Dashing, Elegant, Fantastic, and the Gaudy PLC. Number of shares in each of them. So the number of shares in Dashing is 60,000, 80,000, 100,000, 125, 100,000 shares, sorry, 60,000 shares, 80,000 shares in Elegant, 100,000, then 125,000. Market price per share in each of the companies. Market price per share, there is difference between market per value or nominal price of the shares and the market price. Our focus is on the market price. So you don't use the nominal price. So 4.29, 2.92, 4.29, 4.29, 2.92. Next one, 2.17, 3.14, 2.17. Let me write that. 2.17, then 2.14, 3.14 rather. Here is 3.14. Okay, so let's get the market value. To get the market value, just multiply number of shares of 60,000 multiplied by 4.29 equal 257,400. 257,400. The next one, 80,000 multiplied by 2.92 equal 233,600. 233,600. Then 217,000. 217,000. Okay, 217,000. So the next one, 125,000 multiplied by 3.14 equal 392,500. 392,500. Let's add it up. So the total will then be equal to plus 217,000 plus 233,600 plus 257,400 equal 1,100,500. 1,100,500. Okay, so the beta value of individual security is 1.16, 1.28, 1.16, 1.28. Next one, 0.9, 1.5, 0.9, 1.5. Okay. So to now get the weight, I need to multiply the total market value with the beta value of individual securities. Therefore, 257,400 multiplied by 1.16 equal 298,584. Next one, 233,600 multiplied by 1.28 equal 299,008. 299,008. Next one, 217,000 multiplied by 0.9 equal 195,300. 195,300. 392,500 multiplied by 1.5 equal 588,750. 588,750. Let's add it up. Plus 195,300 plus 299,008 plus 298,584 equal 1,1381,642. So to now get the overall beta will be equal to total weight divided by total market value equal 1,381,642 divided by 1,100,500. So what do you get? Divided by 1,100,500 equal 1.26. 1.26. So I need to interpret this. So the overall beta of balloon PLC short-term investments, portfolio is 1.26. This means that the risk of the portfolio is higher than that of the market, which is 1. Okay, so that answers number A, requirements. So let's go to B. Number B, requirements. You are to recommend, giving your reasons, whether the composition of the company's short-term investment portfolio should be changed. In order to recommend whether the composition of the company's short-term investment portfolio should be changed, we depend on the alpha value computed. How do you know you are supposed to compute alpha? It's given if in the question you are given expected return, you need nobody to tell you that you are expected to calculate alpha value. Even though in this question you are not directly given expected return, but the information is there to compute the expected return. Because I can see dividend yield per annum. Yield is the same thing as return. So capital gains yield is also a return. So all we need to do first thing first is to calculate expected return. After we calculate the expected return, we calculate the required return using CAPM. Then step 3, we need to calculate alpha value. All right. Once we determine the alpha value, we move to step 4, which is to advise. All right. So quickly, let's do that. So number B, requirements. So calculating alpha value. Before you can calculate alpha value, you need to determine the expected return. So calculating expected return, ER. How do I calculate? In most cases, this expected return is usually given, but in this situation, it wasn't directly given, but we have the information to do that. So I will list the companies, then the dividend yield in percentage, capital gain yield also in percentage, then my expected return in percentage as well. So company Dashing PLC, Elegant, Fantastic, and then Gaudy. The dividend yield given in the questions, the dividend yield given is 6.1, 3.4. 6.1, 3.4. Next one, 5.7, 3.3. 5.7, 3.3. Capital gains, 13.4, 20.6. 13.4, 20.6. Next one, 11.8, 19.7. 11.8, 19.7. Okay, let me confirm. 19.7. Yeah, it is. So to now get the expected return, I'm expected to add up the two returns together. So this will now be equal to 6.1 plus 13.4 equal 19.5%. Okay, here will be 24.0. Then here will be 5.7 plus 11.8. equal 17.5%. Finally, the last one, 3.3 plus 19.7, 23.0. So the expected return is what we just computed. So let's go and put it there. 19.5, then 24. So after we have done with the expected return, then we need to calculate. This is B1, step 1, then 2. We need to calculate the required return. Calculating the required return. Required return, which is CAPM. Calculate CAPM. Okay. Now, so the required return, denoted as RS, is equal to the risk-free rate of return plus the beta value into market return minus the risk-free rate of return. Let me rewrite the beta. Okay. So for dashing will be equal to, go back to the question, what's the risk-free rate of return? The risk-free rate of return is 11%. Market return is 19%. So the risk-free rate of return is 11. Here is 11 plus the beta of dashing is 1.16. 1.16. Market return is 19 minus 11. So equal. So I would then say 8 multiplied by 1.16 plus 11 equal to 20.28. Here is 20.28%. Then for elegant, 11 plus the beta of elegant is 1.28. 1.28 multiplied by risk premium of 8. The difference between 19 and 11 is 8. Therefore, 8 multiplied by 1.28 equal plus 11 equal 21.24. 21.24%. Then for fantastic, 11 plus beta of fantastic is 0.9. 0.9 multiplied by risk premium of 8. Let me write that, 0.90. Okay, so 8 multiplied by 0.9 equal plus 11 equal 18.2%. Then for Gordy, 11 plus 1.5 into risk premium of 8 equal 8 multiplied by 1.5 plus 11, 23%. 23%. So that's that. Now that we have computed the expected return, we've also determined the required return. Then let's compute the alpha value. So step 3 now. B Roman figure 3. Calculating alpha values, denoted as this. That's alpha. So we have the companies. Company dashing, elegant, fantastic, and gaudy. Okay, expected return. The expected return is 19.5, 19.5, 24.0, of course, in percentage. Okay, then 17.5, 23, 17.5, 23.0. Then the required return also in percentage is 23, 20.28. Here is 20.28%. Next one, 21.24%, 18.2, then 23. Okay. Therefore, alpha will be equal to, let me adjust that. Alpha will be equal to 19.5 minus 20.28 equal minus 0.78. Alpha is also in percentage, so minus 0.78. Next one, 24 minus 21.24 equal 2.76. 2.76, then 17.5 minus 18.2 minus 0.7, then 23 minus 23 will be equal to 0. So if you like, you can introduce a comment or remark. Okay, provided the alpha value is negative, it means it is overvalued. Okay, this is also overvalued. So if the alpha value is positive but greater than 0, then it is undervalued. If the alpha value is equal to 0, it means that it is properly valued. So that's that. We are done. So all we need to do now is to advise. Okay, we need to advise. What should be our advice? Remember, in the question, examiner is asking that we should recommend, given your reasons, whether the composition of the company short-term investment portfolio should be changed. So whether the composition of the investments portfolio should be changed or not will depend on the alpha value computed. So we have calculated our alpha, and we want to recommend on what the company should do. So recommendation. Okay, recommendation number 1 or number A. Don't let us use A, let's use figure 1. Figure 1, recommendation. You will notice that the investments in D and F are overvalued. So I would then say the shares in Dashing PLC and Fantastic PLC are overvalued. As a result, the shares should be disposed of. So it should be sold. The shares should be disposed of. You sell it off because they are already overvalued. Then number 2, the shares in Elegant PLC. The shares in Elegant PLC are undervalued. Therefore, more of the shares should be bought. Therefore, more of the shares should be bought so that in the future, once the price increases, then you dispose it off to make more gain, more profits. Then number 3, the shares in Gaudi PLC are properly valued. Hence, they should be kept. They should be kept until the price increases so that they can sell it and make more profits. Hence, they should be kept, or the company should hold on to the securities, or the company should hold on to the security or shares. So that's that. That's that. If you want to flesh it up, you can talk more, because when you look at the expected return, of each of the securities, you will notice that for security, let me go back to the question here. When you look at all the beta value of individual securities in this portfolio, you will notice that all of them, they have a beta value that is greater than 1, that is greater than that of the market, except Fantastic PLC. It's only Fantastic PLC that has a lower beta value relative to the market. So which means that, of course, there are the risk of, that's why you see the overall risk of the portfolio is higher than that of the market, because individual security has a higher risk. Let us also look at the return. The return of individual security too should be higher. Okay, the return of individual security should also be higher. Look at the return. This is the return of individual security. You will notice that the higher the security, the higher the expected return, the higher the risk. When you look at the risk of dashing, okay, let me even use this one. The risk of that, this is the risk, this is the return. All right. When you look at the risk of dashing is 1.16. The risk of Fantastic is 0.9. Look at the return of, the risk of dashing is 1.16. The return of dashing is also 20.28. But for Fantastic, the risk is 0.9. The return is 18.2, which is consistent with the assumption that the higher the return, the higher the risk. Okay, the higher the return as well, and then the higher the risk. Okay, so when you look at for Gaudi has a risk of 1.5, but the return is the highest, which is 23%. Okay, so the investors can decide can change the portfolio if the risk appetite is below what the portfolio risk is given. So you can invest instead of investing in company dashing, elegance, fantastic, and gaudy, the investor should just put all the resources in government securities or bankers' acceptance or any other short-term marketable securities to lower the risk. Of course, when you invest in any of those short-term marketable securities, the return will also be low because their risk is lower, then the return will also be lower. So that is that. Then number C of the question, the number C of this question, you have to discuss the factors that a financial manager should consider when investing in marketable securities. So to answer this question, you need to put yourself in the position of a financial manager. Okay, put yourself in a position of a financial manager that you want to invest in short-term marketable securities. It's supposed to be 3. So you put yourself in a position of a financial manager that you want to invest in short-term marketable securities. What are the factors you need to take into consideration? So factors to consider when investing in short-term marketable securities. Number 1 factor is initial investments. If you don't have the initial investments, of course, you won't be able to undertake the investments. So initial capital is one of the factors to consider. Number 2, you also need to consider the tenure of the investment. Okay, how long is the investment? Is it for 3 months, 6 months, 180 days, or 1 year? Short-term marketable securities should be 1 year and below. So tenure. Okay, then number 3, you need to consider the inflation, the impact of inflation. You want to know whether inflation will impact the investment, because generally inflation will lower the purchasing power of money. The value of the money will reduce, value of the investment will reduce as a result of inflation. So you want to know if inflation will impact the investment as a financial manager. Then number 4, as a financial manager, I will also consider taxation, the impact of taxation. When I dispose of my investments, am I going to incur any tax liability? So I need to consider that. Then number 5, you also need to talk about liquidity. Okay, liquidity is the ability to sell the securities when the need arises. Okay, ability to sell the security when the need arises. So the liquidity. So the investment should be liquid enough. All right, it's not something that will stay for too long for me to be able to sell. Okay, so I also need to consider liquidity. Then number 6, I can also consider, depending on the nature of the investment, if the investment is will include or will involve foreign transaction, right? Then I need to consider the impact of foreign exchange. So the impact of foreign exchange, okay? Because if foreign exchange will impact my investments, then it will make the value to be susceptible to gyration. All right, to make the value of the investment to be susceptible to gyration. So these are some of the factors you need to take into consideration as a finance manager when you are undertaking short-term investment decision. There are more than this, but I think this is okay. You can do more than this. All right. So that's end of the question. You can just go and look at illustration number 3 as an assignment. Go through the number 3 as an assignment. When you are done, you can share with me on the comment section. So just go to the comment section on the YouTube that, okay, I've done illustration number 3. Please, can you share the solution? I will provide you with the solution. All right, so ensure you attempt this illustration number 3. All right, so that will show that you are gaining something. Okay, so that will be that for today. Please, I will encourage you, subscribe to my YouTube channel so that subsequently you can receive notification for more valuable videos going forward. Not only that, when you subscribe, you comment, or you even share with your friends and colleagues, you are encouraging me to do more. All right, thank you guys for your time. I will see you in the next class. Bye bye.